Hello, this is Dale. This video is aimed at all retail investors, especially those that have a larger portfolio, because what I'm going to show you is how to eliminate stock market losses by using a protective put. My name is Dale Brethauer. I've been a trader for greater than 4 decades, hedge fund manager. I currently am the stock option coach, founder of www.optionsinfinity.com, which I believe is the very best option education website available today. So what is a protective put? A protective put is a put option you buy to protect your portfolio of stock against the downturn. You've worked hard for that portfolio and you don't want to give it back during a market downturn. Market downturns usually happen 5 to 7 times a year, with only about 1 or 2 times the greater than 10%, but you never know when that big downturn is going to occur. Now, with a protective put, as your portfolio goes down in value during that downturn, the put option will increase in value, and that counteracts the portfolio loss. Let's take a look at a 2-month chart of the SPY, Standard & Poor's 500. And I want to go back to right around September 15th of 2023. And let's say you're looking at this chart and you decide that the market is starting to soften a little bit and you want to protect yourself against a loss of, 5, 6, as much as 10, 15%. So you decide at this point what you're going to do is buy a protective put. Let's say on September 15th, you feel the market is going to soften and you buy that protective put. I like to use the SPY as my instrument to do the hedging or the protection. First thing you want to do is you take your portfolio size, and this can be anything, but for this example, I'm just going to use a rough number of $100,000 for the portfolio. This can be anything your portfolio size is, and what you want to do is you want to divide that by the current price of the SPY. In this case, on September 15th, the SPY was at 444. Therefore, for our fictitious $100,000 portfolio, we would want to buy 225 shares of the SPY. Well, an option contract is 100 shares. So I'm going to want to round this up, and I always round up to the upside. So rather than getting 200 or 2 option contracts, I'm going to go ahead and buy 3. And these are going to be at the money. So I went out a couple months to 17 November, and I bought the 450 puts at $7.60. Now the delta of that put at that time was 0.48. And I want to show you in the next slide, delta, basically the delta of 0.48 means that I'm going to be protecting to start out with half of my portfolio, because for every dollar that the SPY moves, the option, the 17 November 450 put, is going to only move 48 cents. So I'm getting about half the protection, but it's less expensive. So the cost of that's going to be $760 times 3 times 100, or $2,280 to get your protection on your $100,000 portfolio. Are we going to lose this? No, never. We're going to lose this. Okay. We might give some of this back if the portfolio actually does not go into a downturn, but actually rises. But the beauty of this strategy is if the portfolio rises against the option that you bought, the put option you bought, you're going to make money on the portfolio and lose a little money on the option for a net of a positive gain. This is a win-win strategy, and I'll go over an exact example of that in a couple slides. Now, let's say we hold on to that option until around October 27th when we sell that put that we bought for $7.60 will now be worth $36.50. And the delta is 1. So in other words, we have increased our protection as the market has dropped, which is a beautiful thing. Our protective put profit then was the $36.50 minus the $7.60 times 100 times 3, or $8,670. Now, originally we had 225 shares, and now the SPY is worth $410. So that $225 per share is only worth $92,250. If you had held and not protected your portfolio, you would have had about a 10% loss during the time period that we showed. However, because you bought protection, you now add that profit back in, and you'll notice that the $100,000 that you started out with is not only protected, but is still there when the market has finished with its downturn. Let's go back and take a look at this chart. Okay, we had $100,000 right here, and you went all the way through this downturn, all the way down here to about October 27th. This is a lot of sleepless nights and a lot of anxiety. And what you ended up when at the end of October 27th is a portfolio that's the same size roughly to what your portfolio size was all the way back here. Now you're starting out with that $100,000, and if the market goes back up, you not only are going to gain that, but you don't have to gain back everything you lost here. You're starting out with the exact portfolio size down here you had when the downturn began. Let's take a little more closer look at this delta of 0.48. What does that mean exactly? Well, the delta is a ratio comparing the change in price of the asset, usually the marketable security or the SPY in this case, to the corresponding change in the derivative or the option. For example, if our stock option has a delta value, which it did, of 0.48, that means that if the underlying stock or the SPY increases by $1, the option will only rise 48 cents per share, all else being equal. And that's kind of a nice thing, because if it goes against you, that means you're only losing half the amount on your option protection that you had. The further that drops, the more strength you get from your protection as it gets closer and closer to a delta of 0.10. One of the nice things about doing videos like this, when I send these out and when people go to my website and also to my YouTube channel to view these, you can always stop this at any point in time, rewind it, take a look at it, fully understand it, review it a couple times until you fully can grasp what I'm talking about here. Now let's just take a look at a current SPY chart. And this is, I'm taking this from, let's say back here around, I think it was December 28th, the market started softening, and you're thinking, well, I'm going to go ahead and buy protection, and that's looking good. It's looking good. And then all of a sudden you have a couple big up days, and you go, oh man, I could have had that if I wouldn't have bought protection. However, the amount of money now that you're losing on that protective put, you're gaining on your portfolio. So this is a win-win situation. Let's take a look at the numbers. Let's say on December 28th, we feel the market is softening and we buy a protective put. You're going to take your portfolio, once again, we're going to just use $100,000 for example, and divide it by the current price, which then was SPY was worth 477. Remember, that's the instrument we're going to use to buy protection against whatever portfolio size you have. That's going to equal $100,000 divided by 477, or 210 shares I want to protect my portfolio or hedge it against a loss. Once again, I want to round this up. I'm going to buy 3 at the money, 16 February 475 puts at $6.15. Of course, it's a delta of 0.41. So in this case, the market's going to drop, but then it's going to turn around and go back up. And that delta of 0.41 is going to be in our advantage. Now, the cost of that's going to be $6.15 times 3 times 100, or $1,845. Now, on 1/4, with the market dropping, that put is now worth $9.69, and you can see that the delta is increasing. It'll keep increasing as the market drops till the delta gets to be 1. Our protective put profit at that point in time is $9.69 minus the $6.15 original cost times 100 times 3, or $1,000.62. The 210 shares that we have on January 4th are worth $468, or your portfolio of $100,000 is now only worth $92,280, or this has been a small correction of about 2%. These happen all the time. You never know where you're going to get that big drop, and you really want to have your protection on just in case. But here it only dropped 2%, but we made that 2% back. So at the end of the time period until January 4th, we're just about even again. Okay, so that $100,000 is intact. Let's go back and take a look at that chart. Okay, so during this time period, once again, no sleepless nights because we've got the protection. But now what happens when it gets down there and turns around? All right, the beauty of this strategy is that this is a win-win strategy. If you decide to hold that protection and not sell it, and then the market goes back up, that's not a problem. It's a win-win strategy because when the market goes back up, your portfolio is going to increase in size as the protective put decreases. Okay? So it's not going to increase as much as if you didn't have the protection on, but you still have protection and you're still going to get that increase in your portfolio. So on January 4th, you would have had $99,342, and you still had 3 at the money 16 February 475 puts that you bought at $6.15. And all of a sudden the market turns around, and on January 9th, you decide, hey, I'm going to get out of that protection. The market looks like it's turned to the upside. Oh, okay, the put is now only worth $6.21, and I'm out. I sell it. I made a little profit, not much to speak of, almost negligible, but the $210 shares are now worth $474. The SPY we're using as the portfolio index fund that we're using is worth $99,548, plus that 18 is once again $99,558, very close to the $100,000 we started out with. So in this example, you've seen putting on protection, having it go in our favor, and then, oh, okay, the market's going back up again. That $100,000 portfolio we had right here, we still have right here. This is a win-win strategy. There's no reason, if you have a larger portfolio, that you shouldn't use this protection every time you feel uncomfortable about the market and the possibility that you might see a downturn. The key is to know when to buy and sell your protection. Now, as I said earlier, I am the founder and chief trader for www.optionsinfinity. There are two ways that you can join me. One is, as a lifetime member, you pay $2,000 up front. I'm going to teach you exactly when to buy and sell for protection. And I'm going to show you exactly what protection you use. But you're going to get everything you get in the monthly membership for the rest of your life, plus 4 hours of lessons on how I trade and access to my exclusive Facebook community where I talk to you about what the market is doing in general and what you should do to protect yourself if I see a downturn coming. And I'll show you exactly the indicators that I use to look for that advanced warning. The other option is to just join me on a month-to-month basis, and that is going to be $100 per month. You can cancel at any time. What this allows you to do is I teach how to trade credit spreads on the SPX, the SPY. Credit spreads are what I believe is the most conservative way to earn money on a regular basis. And this is what I teach for the month-to-month membership. If you want to go with the full-blown lifetime membership, it'll be paid off in a little over a year. Plus, you're gonna get all the access to my knowledge on when the general market is going to go up or go down. And I have picked the tops and bottoms correctly for the last 11 tops and bottoms in the market the last 2 years. This is just the returns on margin that my members have seen, the monthly membership members, and I'm taking this all the way back to 2020, and you'll notice that before that we had a little drop with the coronavirus, but this is the kind of equity curve you're looking for. Yeah, I'm going to have losers. Yeah, I'm going to have losing streaks. Nobody can give you 100%. But my strategy for credit spreads shows about 75% through the life of what I've been doing and what I've been publicly teaching. So what I would like to see you all do, whether you choose a lifetime membership or the monthly membership, to go to www.optionsinfinity.com, take a look at the website, see if it's something that you might enjoy, and I'd love to have you join us as a member, either a lifetime member or on the month-to-month basis. Thanks for your time, and I hope that this video helps a lot of people. Bye-bye now.